A comprehensive study by Dalbar has shown for decades that the average investor consistently and dramatically underperforms the market. It's not because they pick bad investments. It's because they buy and sell at the worst possible times, buying into hype at the peaks and panic selling in the troughs. They are trying to time the market, and the data is unequivocal. For over 90% of people, professionals included, timing the market is a losing game. But what if you could use a system that makes timing irrelevant? In the next 10 minutes, you will learn the mathematical mechanics of a strategy called dollar cost averaging. It is a simple, automated system that not only removes emotion and guesswork from investing, but actually weaponizes market volatility to your advantage, systematically lowering the average cost of your investments over time. This is the antidote to market chaos. So, what is dollar cost averaging, or DCA? The definition is remarkably simple. It is the practice of investing a fixed amount of money into a specific asset at a regular interval, regardless of what the price is doing. For example, you decide to invest $500 into an S&P 500 index fund on the first of every single month. Whether the market is soaring, crashing, or moving sideways, your $500 is invested automatically. The core purpose of this strategy is to solve two problems. First, it solves the behavioral problem. It automates your investing, removing fear, greed, and the impossible burden of trying to predict the future. Your discipline is outsourced to the calendar. Second, it solves the entry point problem. Instead of making one big bet on a single day, hoping you chose the right one, you make dozens or hundreds of smaller bets over time. This diversifies your purchase price across bull markets, bear markets, and everything in between. It smooths out your journey. The psychology is powerful, but the mathematics are even more compelling. DCA doesn't just manage risk, it actively exploits price fluctuations to lower your average purchase price. How does this counterintuitive process actually work? Let's run the numbers. Here is where the strategy reveals its true elegance. Theory. The power of dollar cost averaging comes from a simple mathematical truth. When you invest a fixed dollar amount, that money automatically buys more shares when the price is low and fewer shares when the price is high. Over time, this forces you to accumulate the majority of your shares at cheaper prices, thus driving down your average cost per share. Analogy: the weekly fuel budget. Imagine you don't own a car, but a fleet of them, and your budget for fuel is exactly $1,000 every month. In January, the price of fuel is high at $5 a gallon. Your $1,000 budget gets you 200 gallons. In February, a supply glut causes the price to crash to $2 a gallon. Your same $1,000 budget now gets you a massive 500 gallons. In March, the price recovers to $4 a gallon. Your $1,000 buys you 250 gallons. Without ever trying to predict the price, what did you do? You naturally and automatically bought the most fuel when it was the cheapest. You spent $3,000 and acquired 950 gallons. Your average cost per gallon was $3,950, so $316. Even though the average monthly price was 5 plus, 2 plus, 4 dear, and 3 beers, 367. DCA applies this exact automatic efficiency to your investment portfolio. Let's say you commit to investing $200 a month into an index fund. Month investment, share price, shares bought. January $220 tendo. February $200 1020 borrow. March $200 $15 for pomtere. April $225 8.0. Look at what happened. In February, when the market dropped 50% and everyone else was panicking, your system forced you to buy twice as many shares. You were buying on sales. Now, let's calculate the result. Total invested, $800. Total shares acquired, 51.3 shares. Your average cost, per share, 800, 51.3 Sundays, 1559. The average market price, 20 by 10 by 15 by 25, Vesar Botox of the 1750. Your average cost per share is almost $2 lower than the average price in the market during that period. You won by being disciplined, not by being a genius. This is the foundation of long-term wealth management. It's the strategy. DCA is powerful, but it's not a magic bullet. There are two critical nuances to understand. Pitfall. Number 1. The lump sum debate. What if you receive a large sum of money, like an inheritance or a bonus? Should you invest it all at once, lump sum, or DCA it over time? Statistically, since the market goes up more often than it goes down, lump sum investing has been shown to outperform DCA about 2/3 of the time. However, this ignores the emotional reality. Investing a large sum and watching it immediately drop 10% can be psychologically devastating. DCA is the superior tool for managing risk and regret. For your regular income, DCA is king. For a windfall, DCA is your psychological insurance. Pitfall number 2. Stopping during a crash. The biggest mistake an investor can make is to stop their DCA plan during a market downturn. A crash is when DCA provides the maximum benefit. It's the period when your fixed dollars are buying the most shares. Stopping your contributions then is like walking out of a grocery store because your favorite items just went on a 50% off sale. It makes no logical sense, but fear drives people to do it every time. Understanding when and why to use this strategy is vital, but there's a more dynamic version of this concept that can potentially enhance your returns even further. Dollar cost averaging's lesser-known, more aggressive cousin is value averaging. The goal is different. With DCA, you invest a fixed dollar amount each period. With value averaging, you ensure your portfolio's value increases by a fixed amount each period. Here's how it works. Let's say your goal is for your portfolio to grow by $1,000 every month. Month 1, you start at $0. To reach your $1,000 target, you invest $1,000. Month 2, the market was strong, and your $1,000 is now worth $1,200. Your target value for this month is $2,000. To get there, you only need to invest $800. Month 3, the market crashed. Your $2,000 portfolio is now only worth $1,600. Your target value is $3,000. To get there, you must invest $1,400. Value averaging is a systematic framework that forces you to be even more aggressive in buying the dips and more conservative in buying the rallies. It is more complex to manage, but studies suggest it can lead to higher returns. It is the logical extreme of the DCA philosophy. Let's distill this down to the 3 core principles you need to remember. Timing the market is a trap. The goal is not to predict the future. The goal is to have a system that succeeds regardless of the future. Dollar cost averaging is that system. DCA weaponizes volatility. By investing a fixed amount on a regular schedule, you mathematically guarantee that you buy more shares when they are cheap and fewer when they are expensive, lowering your average cost over time. Discipline is the strategy. The power of DCA is unlocked not by brilliant analysis, but by unwavering consistency, especially during market downturns. For a more advanced approach, consider value averaging to double down on buying the dips. This isn't about being the smartest investor in the room. It's about being the most disciplined. If this analysis provided you with real value, invest a single click in the subscribe button to get daily access to the Codex. Knowledge is the new capital. We'll see you tomorrow.